Good morning, everyone, and welcome to the Sustainable Finance webinar organized by Bahrain Association of Banks, BIBF Sustainable Development Committee, and hosted by Bahrain Institute of Banking and Finance. In a world with global population over 7 billion and growing, whose basic needs have to be met, where natural resources are increasingly rare and climate disruptions are becoming more frequent, markets are changing rapidly. A new approach of banking is needed to adapt to new realities. I'm looking forward for today's discussion on the importance of sustainable development goals to the financial sector and to better understand the opportunities as well as the costs of inaction. I'd like to welcome Dr. Ali Adnan, the chairman of Bahrain Association of Banks Sustainable Development Committee, for his opening remarks and introducing today's speakers. Dr. Ali.
Many thanks, Siba, and huge thanks to Bahrain Association of Banks for co-hosting this webinar with Bahrain Association of Banks. And a very good morning to you all, ladies and gentlemen. On behalf of Dr. Waheed Al-Qasim, the chairman, the CEO of Bahrain Association of Banks, to this webinar series on sustainable finance. Bahrain Association of Banks has been one of the very few industry associations who have had a permanent committee on sustainable finance since 2017, and Ziba has been part of it. And thank you so very much for all your contributions, Ziba. And the committee initially developed a policy framework document, and then under the guidance of the board of the Bahrain Association of Banks, we started working towards its implementation. As a result of that, Tamkeen very graciously and very kindly issued one of its very unique blended finance facility for the banking sector in Bahrain to start financing renewable energy in Bahrain. And we have also been working with the Central Bank of Bahrain, who have been very keen and eager for us to make more progress. And without any further delay, we are absolutely grateful and honored to have been joined by two exceptional speakers today who continue to champion sustainable finance globally. Ladies and gentlemen, please join me in welcoming Mr. Eric Usher and Ms. Catherine Garrett-Cox. And I would invite you all to read their bio, which has been made available. But very quickly, I would like to say a few words to introduce Mr. Eric Usher and Ms. Catherine. Mr. Eric heads the United Nations Environment Program Finance Initiative, a global partnership bringing together the UN with a global group of banks, insurers, and asset managers working to develop sustainable finance and responsible investment agendas. Over the years, UNEP-FI has established some of the most important sustainability-oriented frameworks within the finance industry, including the Principles of Responsible Investments in 2006, the Principles of Sustainable Insurance in 2012, and the Principles of Responsible Banking in 2019. Prior to leading UNEP-FI, Mr. Usher has over 20 years of experience in the low carbon sectors. Mr. Usher worked on the establishment of the Green Climate Funds and led to the creation of its private sector facility. Eric has been an editor of Global Trends in Renewable Energy Investment Report, published annually with Bloomberg, and was lead author for finance of the IPCC Special Report on Renewable Energy Resources. Welcome, Eric. And Ms. Catherine Garrett-Cox. Catherine is a managing director and chief executive officer of Gulf International Bank UK Limited, which is a subsidiary of Gulf International Bank Bahrain. Catherine was formerly chief executive and chief investment officer of Allianz Trust PLC, one of the Europe's largest providers of sustainable and responsible investment funds. She is a member of the supervisory board of Deutsche Bank, and she has also served as a member of the UK Prime Minister's Business Advisory Group from 2012 to 2015, and the Scottish Business Board during the same period. Catherine is currently the chair of the Clean Air Fund, and she is also the chair of CDP Worldwide and member of the UK Society of Investment Professionals, CFA Institute. Catherine was nominated a Young Global Leader of the World Economic Forum in 2006 and was awarded a Commander of the Order of the British Empire in the 2014 New Year Honors List for her services to charity and to the asset management industry. Welcome, Catherine. And starting the discussion right now, if I may start with Eric. Currently, UNIP-FI is one of the largest forces to reckon with on sustainable finance. You started your journey in 1992, much earlier before the SDGs, much earlier, much before the even MDGs. And now, if you look at the investor base who have signed up to the principles of responsible investing, they are more than $80 trillion. The principles of responsible banking, more than $40 trillion. There's a huge momentum going on. And what do you see? Where is this? What are the reasons why the investment industry is so excited about this? And what are the key global trends that you see?
Well, thank you very much, Dr. Ali, and a real pleasure to be with you today. If not physically, then virtually, as we're all learning to do these days. Even with all the uncertainty, I need to congratulate the organizers for convening this webinar series on issues related to addressing sustainable and responsible finance, and also all the actions that have been taken in Bahrain. I must also, of course, mention that we're deeply saddened with the news about the passing of His Royal Highness Prince Khalifa bin Salman Al Khalifa, and we extend our sincere condolences to the people of the Kingdom of Bahrain. We have the privilege of working with many banks in the region, two from Bahrain, and I'm very pleased to share the discussion today with both of you, who really have been leading on this agenda. And both are signatories to the Principles of Responsible Banking, which we will talk about a little bit, hope, today in the discussion. To come into your questions, Dr. Ali, around the SDG transformation, if I can sort of go back in time a little bit, certainly since 2015, when the Sustainable Development Goals and the Paris Climate Agreement were signed, I would say the pressure has been mounting. Previously, the civil society, the NGOs and others had been continuously raising issues around sustainability, but post 2015, this has really spread, and now it's more, well, it's investors, it's regulators, customers, employees. Everyone has growing expectations that the financial industry play an instrumental role in this sustainable development agenda. And essentially, how do we transition to a more resilient, inclusive, and green economy? Some of the key global initiatives that have emerged in recent years have come out of the necessity to respond to government demands that financial institutions take, I think, an active part in this conversation, and as an active contributor to the notion of sustainable development. Let me go back a little bit further in time. We tend to think or talk about the 1990s as a period when banks really, for the first time, started to understand their role and their responsibility and their liabilities potentially around what were initially environmental risk issues and subsequently social risk factors as well. So on a transactional basis, banks started to put environmental risk management systems in place. And then in 2006, as Dr. Ali, you've mentioned, we had the privilege of launching with the UN Secretary General, Kofi Annan at the time, the Principles for Responsible Investment. 6 years later, we did the same with the insurance industry to launch Principles of Sustainable Insurance. These are two very important, if I can simply say, risk frameworks for how to integrate environmental, social, and governance considerations into investment and insurance underwriting, and really have framed up and become a very strong, I would call it, mainstream approach to how do we address these important issues. At that time, there was always discussions around, well, what about the banking industry? Is there not a set of global principles that can apply to banking? And typically the response was, well, we have many different lines of business, and we do have some frameworks already, the Equator principles for those who know them, which applies to project finance, so largely infrastructure financing. But interestingly, if you compare the Equator principles with the PRI fits on half a page, it's 6 principles. The Equator Principles fits on 18 pages. So it's very, very specific for sustainability specialists or environmental risk managers to understand whether specific transactions, what sort of due diligence needs to be done on them. So it's not a strategic framework. It's much more a transactional type of risk management framework. Post 2015, as I'd mentioned, many actors started to push, I would say, beyond the bounds of just understanding your transactions from an environmental social risk perspective. And banking regulators, particularly, I can refer to Mark Carney, who was the governor of the Bank of England at the time and chair of the Financial Stability Board. He began to speak in the lead up to the Paris Climate Agreement. He started to speak about climate change and the need for actors in the financial sector to take heed of climate risk exposure within company strategy and portfolios. We then had the French and Dutch central bank governors starting to send similar signals. And by 2018, a new network for greening the financial system, what we call the NGFS, was established, and this is a group of central banks and financial supervisors, which today has grown to 75 members, including 4 from the region, 2 from your neighboring UAE, the Abu Dhabi Financial Services Regulatory Authority, and the Dubai Financial Services Authority, plus the Central Bank of Morocco and Central Bank of Tunisia. This group of 75 central banks, this is the first time they've started to talk about and acknowledge that sustainability considerations actually is part of the mandate of central banking, that we can't have a stable financial system unless we also have a stable planetary and social environmental system around us. Just last week, we've heard that in the US, the Fed is also making movements towards joining. And so there's been a lot of developments on the regulatory front in terms of developing or building the financial sector response towards meeting the goals of the Paris Agreement and increasingly in other areas as well, which I think we're going to talk a little bit about today. For instance, nature and what it means to understand the stability issues related to our, I would say, unsustainable relationship with nature today, and COVID-19 being just one example. So we've seen a lot of development on the regulatory front. And with this combination of pressures of investors through the PRI, of regulators, and also customers, clients, staff, leaders in the banking community finally decided to step up. So the post-2000 world really was changing quite quickly. And that's what led them in 2018 to draft, under the auspices of the UN, a set of global UN principles for responsible banking. I hope we'll have the opportunity to speak a little bit more about the PRBs further in the session. But with that, Dr. Ali, I hand it back to you.
Sure, thank you. I think this was very helpful to understand the global dynamics and the macro picture. We'll definitely do a further deep down into PRB and other strategies that you are implementing. So let's move very quickly to Catherine. Catherine, you are an asset manager and you are managing billions of investors, your clients' money, and also Sharia compliant way. And you have been in the sustainable finance movement, and you have seen this industry grow from nowhere to in trillions of dollars. What are the clients looking at it? Why there is so much excitement in your investor base about this?
Well, Firstly, thank you very much indeed, Dr. Ali, for inviting me to be part of this conversation. And again, huge thanks to the organisers for pulling this together, because this is so critical. I mean, I think that where I would start is, why does this actually matter? And why has the financial services industry reacted to the whole field of sustainable development, however you badge it? And I think that, you know, the key thing to remember, and actually this is where Ziba started, is that humanity is facing challenges on so many different levels at the moment. It isn't just issues around water security, food and agricultural security, but it's also around future energy and climate change challenges. And I think in terms of just some raw facts that I sort of felt might frame my remarks, the risk is that 2/3 of the global population are going to face water shortages by 2025 if current consumption rules and rates are maintained. And we've got around 11% of the world's population suffering from undernourishment, which seems extraordinary if you think we're sitting here in 2020. It doesn't take me to tell you that everyone is feeling the impact of climate change, whether it's warmer weather and more severe weather. But again, back to this point about water scarcity. And I think that was all before the COVID pandemic. And as we know, the pandemic itself is estimated to risk pushing between 70 and 100 million people to extreme poverty. And many of those people, probably around 10 million, will be in areas of fragility, conflict and violence. And the challenge is that it's not just the risk to humanity, it's also how much this is going to cost to put right. And initial estimates are that the pandemic is going to worsen the financial situation by adding probably around 20% to the world's humanitarian bill. So these are substantial sums that we're going to need to find to put right. I think, you know, the finance sector really has a unique role to play in addressing some of these global challenges. And I think to your point about why is it that clients are interested in this, I think there is a growing realization that the finance sector has the power to allocate capital in a way that can support sustainable development. And most importantly, back to some of the things that Eric was speaking about, it will help us to manage sustainability risks. And I think for years, my perspective has been that this isn't something that is a nice to do or an on the side. This has to be absolutely embedded in your business strategy and framework. And to pick up something that Ziba said at the beginning, the cost of inaction is just simply far too great. So I think increasingly what we're finding is investors are coming at this from a risk perspective. It should absolutely be part of your risk management framework. And again, the idea is that we're now being supported in this regard by the many frameworks and initiatives, some of which absolutely Eric touched on. And I think that I feel particularly proud that in the UK, Mark Carney, when he was Governor of the Bank of England, really led the charge around TCFD in terms of requiring organisations to be much more open and transparent about their environmental footprint. So the reality is that in the asset management space, these trends are really, really ringing true. And Eric touched on the fact that in 2006, the Principles for Responsible Investment were launched. Actually, when I was at Aviva, we were very pleased to be one of the first signatories to the PRI back then. So I feel I've sort of lived it since 2006, but this has been a slow game. I think that it's really only in the last few years when you see the trajectory of signatories really having ramped up. And I think we need to make a real differentiation between people who are kind of doing it, as I said, on the side, and people who really live and breathe it. And I feel greatly privileged to have the opportunity to work with GIB, who are a real powerhouse in the region and leading the charge on so many things. But this is absolutely landing. I think when you think about ESG, I mean, it's slightly alphabet soup, but I think it really has environmental, social and governance considerations have absolutely become an essential requirement of investors. And I think people really do take this need to consider all material factors in their investment decisions. And we talked about the fact that there has been significant growth, as Eric mentioned, of investors who take these considerations seriously. Global assets, probably up to around 31 trillion in terms of investors taking these ESG considerations very much to account. And I think then that leads to a really interesting development in the wider field of impact investing, which is still relatively early for some and probably in some ways has too much of a connection perhaps to traditionally sort of aid and development type of functions, but that is coming absolutely to the mainstream. One of the things that I think is incredibly important, and again is something that we're hearing from clients, is how do you make a difference as an investor? And I just briefly wanted to touch on just one trend, which has really been around the growing trend towards engagement. It's the idea that as an investor in a company, you don't just sit and hold the shares until you decide to sell them. You should be actively engaged in that company strategy, and you can make a difference. And so to illustrate the power of that just briefly with a story, I wanted to pick on one SDG, number 14, life below water. It's a topic that I personally feel very passionate about, particularly linking back to the biodiversity losses that Eric touched on. So it's interesting because although you have many investors who say they're engaging on these issues, do companies really move? Around 35% of asset managers say that they're currently engaging on ocean issues. But in the UK, back in 2016, there was a campaign led by investors to persuade Tesco, one of the UK's largest retailers, to source their fish from much more sustainable sources. And this campaign was successful. And the UK Tesco shifted to 100% of seafood from certifiable renewable sources. And actually, they're leading the charge on plant-based meat alternatives now, and they're making some hugely ambitious targets. So I think what I'm really saying, Ali, is the context is there, the demand from investors are there, the institutional asset management community has been there for a while and now excited. And as I see, if you have that triumvirate working together, I truly believe we can achieve great things.
Thank you, Catherine. I think you touched upon some very critical issues, and linking what you said. And before we go back to Eric, could you also expand on the net zero effect on the banking sector and how the traditional investments by the investors in the assets which are not sustainable, how are they at the risk of losing future value of their investments? And what are the trends that you see the banks and the asset managers are more eager to grow their pipeline of assets so that they can future proof? So could you also link that with the do you also see this trend?
I think, absolutely, I think is the answer. And clearly many large organizations, many countries are making commitments towards net zero, but I think honestly, we have a long way to go. I think that the world of investment is probably still on the path of a low carbon transition, and that will probably take some time. So I am hopeful, but when I scan the market, I just don't see a plethora of net zero aligned products and services at this point in time. I think the potential is certainly there, but the world is wrestling between this sort of traditional, I suppose, sort of fossil fuel base. And for years, I've been sort of speaking to some of the very large oil and gas companies about the stranded assets that really exist, in terms of their own, in their own sort of assets. So I'd like to say that these are great initiatives, but particularly in the UK, who'll be hosting COP26 next year in Glasgow, these things are right at the top of the list. But do I actually see still just a lot of talk and probably not much action on the ground? I think we're at that pivot point. And as I said, I really hope that we can make significant progress, because what one company can do by themselves is important, but has a small impact. If you can mobilize a whole banking sector in support of some of these critical factors and show people alternatives, and have the realization that it doesn't mean that you have to have less financial return. I think that's the key point. There shouldn't be a trade-off. You absolutely should be able to manage organizations and have that perfect alignment of profit and purpose. But some of these things are probably going to take a generation to change.
Wow, very beautiful said, profit and purpose. So, Eric, you sit on the board of Net Zero Investors, and my next question was going to be on why SDGs are important for the bank. So, before you address that SDGs and the banking sector, could you also make some comments on the Net Zero Investors and what is the business justification for the net zero investments?
Absolutely. Let me try to wrap the two together a little bit. We see the SDGs. Interestingly, it was negotiated between 195 governments, so it's an intergovernmental agreement, the Sustainable Development Goals. And what surprised us a little bit was it actually didn't take very long before corporates and financial actors started to adopt them themselves. And much quicker, I would say, than we expected. And I think, why is that? The notion of sustainability, sustainable development, people get it. They understand that, we have a finite resources on our planet. And if we don't do anything about it, it's going to come back to get us. And once again, COVID-19, classic example. We need to understand better where the risks lie and how to manage them. And what we found is that the SDGs has become an interesting, I would say, compass for trying to understand what our society's greatest challenge is looking forward. Climate change being, maybe the best understood, or where there's a lot of action. But there are 16 other Sustainable Development Goals dealing with issues like clean water, access to energy, gender, poverty. So essentially, what are the big issues? Now, big issues in themselves, we can see them in our social Facebook feeds or whatever. But what does it mean for our day-to-day work, our business, in whatever business we are doing? And essentially, the SDGs become a compass or a tool to start to map out and understand how society is going to change, how the response to these challenges is going to change our opportunities. And maybe let me take an example from the Paris Agreement, where there's a very specific wording relevant to the finance industry, which says essentially those signatories who are governments commits them to making finance flows, both public and private, consistent with a pathway towards well below 2 degrees of warming, with efforts towards 1.5. And therefore, essentially, it's committing governments to try to figure out how can you foster financial flows towards not only away from activities that are risky from a climate perspective, but also to the places we need capital to go in terms of making this low carbon and climate resilient transition. So that's just one example, one of the 16, but it shows you take an issue, you break it down, you see that governments are starting to put in place actions, policies, regulations. You see that corporates are starting to realize, and coming to Catherine's examples around fisheries, that that there is going to be a transition towards a more sustainable way of doing business. And there's also a growing body of research to say that, if you don't see a policy response towards one of these issues in your own market, that's actually not an excuse to sit back. That's a reason to actually pay more attention. Because, for instance, if we take climate change in terms of stranded assets, there's a general view that, based on the science, we see the progression of CO2 in the atmosphere, and therefore we know there's going to be a policy response. It's going to come. Is it going to come this year, in 5 years, or in 10 years? Well, what we can say is the later it is to come, it'll be more brutal in terms of the essentially the implied cost of carbon that's going to be applied, and the potential for stranded assets, which will result. Therefore, in your market, if you don't see the policy response that the science implies, you should actually get ready and assume that that response is going to come one way or another, whether it's in terms of policies, technology innovation, changing consumer preferences, or all of the above. Essentially, the SDGs becomes a tool to identify these changes in society that are going to happen one way or another, and essentially begs the question within the financial system: are you going to be an actor who is helping make this transition and helping take advantage of the huge financial flows that need to be mobilized, or are you going to be sitting back waiting and then likely potentially suffering from stranding assets in one way or another, stranding businesses? Final comment around that is, and Catherine, you gave very interesting examples, including around Tesco, and I think this notion of net zero since about a year ago has become a year ago it was just a sort of an idea. There had been some small island states and I would say the European Union who were talking about net zero, but frankly, it was considered to be an issue that was really kind of out there. And then in the last 12 months, and particularly in the last 2 months, there's been huge mobilization around the acknowledgement that if we're going to apply, if we're going to realize the goals in the Paris Agreement, so to keep global temperatures below 2 degrees of rising and hopefully at 1.5, this means within developed economies essentially getting to net zero emissions by 2050, and for emerging markets sometime soon thereafter. Now, I think you're probably all aware, this hugely accelerated 2 months ago in New York when Chinese President Xi announced that China would go to net zero by 2060, peaking emissions in 2030, and then quickly on the back of that, Japan, Korea, one by one, governments are essentially saying we're going to go to net zero. Now, 2050, that's still more than a generation out, and most people who are operating in the financial sector today will be retired or maybe not around in 2050. So it's not so much committing to something in the next generation. It's really what are actors doing today. And Ali, you referred to UNIPFI has been with the PRI, has worked with a number of leading global investors and insurers to launch a Net Zero Asset Owner Alliance, which was launched a year ago. We have some of the largest investors in the world, like Allianz, Swiss Re, CalPERS in the US, a number of larger investors and insurers in Australia and elsewhere, who essentially have set a target of 2050, but much more importantly, and you may have seen last month at our global roundtable, they launched their protocol, which basically says if we need to get to net zero by 2050, based on the science, based on what scientists are saying about how emissions need to be brought down over such periods, they've already put out their 2025 target. And essentially their protocol says we're aiming for reductions in the range from 16 to 29% on a full portfolio basis of our emissions, because we see that's needed if we're going to get to zero by 50 along a 1.5 degree centigrade transition. So what does this mean for investors? They set a target. It's basically a business target. Then they need to look across their lines of business, across their portfolios. And quite quickly, you realize that to have a real strategic implementation, you have to get to sectoral thinking. And you need to start saying who are our customers, our clients, which industries are we exposed to, and how will those industries like transport, aviation, road transport, obviously energy, utilities, agriculture, and more. Each one of these industries essentially are going to have to figure out how they're going to transition to net zero emissions. And within that pathway to net zero within the industry, I can also take like steel or cement, you're going to have corporates, companies who are moving quickly, who will be ahead of the game, ahead of the transition, and you're going to have others that are sitting back. And what we hear from investors is obviously everybody takes a different approach, but most are increasingly saying it's not that we're going to divest from specific sectors, but what we are going to increasingly do is try to figure out who are the winners and losers in the transition on a sectoral basis. And we're going to engage to make sure those companies that we own or that we lend to or insure are essentially planning to be the winners. If they're not, we're going to look very carefully and try to understand what sort of risks are being exposed. And first of all, we're going to vote our shares to head in the right direction, and potentially eventually we may divest. Final comment on this is the financial system is an ecosystem. There are many players playing different roles, and to be successful in this transition, everybody needs to be stepping up, all parts of the system. And I'll come back to the global fisheries example that Catherine, you raised. Investors can certainly have an important impact engaging with companies like Tesco, who obviously are big buyers of fish products, are an important part of the value chain. Obviously, investors can work directly with the fisheries companies on their sustainability practice. But as we know, different parts of the economy are financed in different ways. And, one of the challenges we have in certain industries is maybe you don't have institutional investors who actually are playing that much of a role. It's more the banks. And certainly as industries get into trouble, as we know, as companies maybe in old industries, start to lose their value, it's no longer the investors actually have that much sway. It's often more the bankers or the bondholders. And therefore, we need all actors to be understanding and playing a role. In the fisheries example, a couple of years ago, we had the privilege of working with a group of global insurers who basically said, we want to deal with pirate fishing. It's called IUU, which essentially are, fishing using the wrong sort of nets that are basically just pulling everything off the bottom of the seafloor, creating a lot of damage. And what the insurers basically realized is the companies who were doing that, they actually didn't have institutional investors behind them. And so although the investors were concerned about the issue, they didn't have much leverage on those companies. But to run a fishing fleet, you need insurance. So the insurers realized that they had quite some leverage on this part of the industry, and that they themselves would start to set standards and say, we will no longer insure fishing fleets that apply certain practice that has been shown. It's come up on these lists as what's termed pirate fishing. And therefore, I think that's just one example. And I think there are many other parts of the financial system that we also need to be stepping up to generally get this alignment to help create this transition across all part of the economy, and particularly all sectors that need to make this shift.
Yeah, thank you so much, Eric, for responding to it very comprehensively. That was truly a deep down, and I think fisheries example made this deep down is very relevant. And Catherine, on I think the winners and losers that Eric talked about, and the financial services sector is very sophisticated sector, and the regulatory role is increasingly significant and has always been there. So what do you see the role of the changing role of regulators? And when we talk about regulators, we see the reporting requirements, the disclosure requirements. So could you help us understand what is the regulatory framework and then the landscape looking like? And if you can also shed light on how the UK is taking the lead in this space.
Thank you, Dr. Ali. Well, I think certainly there's always an element of carrot and stick. I mean, I'd like to hope that people are doing the right thing because they feel it's important, but sometimes you have to mobilize other people in different ways to come to the table. And I think the role of regulators is incredibly important in terms of this topic. And the UK has indeed, I think, led a real global charge when Mark Carney was at the Bank of England, and then obviously at the head of the FSB. I think we made significant progress around encouraging others to really consider how climate-related risks should be incorporated across the banking industry. Indeed, over the last couple of weeks, the TCFD task force, which has made great strides over recent years, has now actually gone one step further and mandated that companies across the UK will have to report TCFD aligned disclosures by 2025. So this is here and now. This is not 2050 or 2060. This is very much here and now. And I think it is all interlinked, because it's not just the banking industry, but it's also how the banking industry, as Eric touched on, finances other industries. It's right, the trickle-down effect. So whether it is also the UK government really mobilising around electric vehicles, for instance, trying to clamp down on terrible emissions in cities, it is all interconnected. And I think that, as we all know, the banking industry is truly global, and a number of big global players are stepping up to this challenge. But I think that, you know, there's always a risk of greenwashing in some of these things. And I think one of the things that the regulatory framework has enabled has been that organizations have been more willing to consider more innovative forms of finance in order to try and tackle both if you like, the path to net zero and the challenge that we face in front of us. So I think it's been fantastic that we have seen significant growth in banks, for instance, launching green bonds back in 2008. The World Bank obviously led the charge on this, and the green bond market is now up to around $760 billion in terms of issuance. But if you think about it, that probably could go a lot further. And I think one of the challenges that we've obviously faced during the COVID crisis is that people have almost centered back on their own issues and concerns. So issuance has, in some parts of the finance market, has fallen back. And what we've got to really hope is that as we get through this, the good news on the vaccines, that people use the framework that the regulators have set to really step up to the plate. And I think, again, you know, I'm really encouraged by what I see in terms of disclosures. Disclosures really matter. So I'm delighted to be part of CDP, which is the global platform for disclosures. And back in 2002, you know, a handful of investors came together and said, right, how do we get corporates to disclose their environmental footprint? Again, using a sort of a framework, a system. And a handful of companies reported at that point. And now around 10,000 corporates this year will be reporting their environmental footprint on a TCFD aligned basis. So again, it's this combination of how the regulators can set a framework that then other people get drawn into to realize that they either have to be part of the conversation or out in the cold. I think just one other brief sort of point I'd really like to touch on is this interconnectivity between Islamic finance and sustainable finance. And for people who perhaps are outside the Islamic finance world, you know, it's not so completely obvious, but it's absolutely there. I mean, they are so closely interlinked when you think about the rules and the spirit of Islamic finance. And we're delighted to be working with the UK Islamic Finance Council on a task force really looking at what disclosures could look like for Islamic finance institutions. So I'd like to say we're right in the heart of it. We're at the right tables, but the opportunities are there, and the regulators are creating the tram lines within which innovative, forward-thinking banking institutions can march. Just one very quick example: green bonds, fantastic, but green sukuk market is tiny at this point in time. I think we've just lapsed the 3rd anniversary of the first green sukuk, but I think global issuance is a sort of handful of billion, maybe 6 billion. I got very excited when I saw the Seychelles issue their first blue bond back in 2018, but it was tiny. I mean, it was kind of, you know, it was $15 million, and it probably has had more airtime than many other bonds that were issued because of its innovative structure designed to support marine conservation and fisheries around the Seychelles. But to my knowledge, there has not yet been a blue sukuk. I mean, that would be groundbreaking. If you think about the amazing coastline that exists in the GCC region, the opportunity for people to connect sustainable finance with a truly groundbreaking piece of financial innovation, I think it would be amazing if one of the banks stepped up and said, you know what, this project, why don't we bolt it together with a sukuk structure? That would be true innovation. That would have impact. Thank you, Ali.
Yeah, fascinating. And I think blue bond and blue sukuk is something very is something to look forward to. And so is social impact sukuk. We have had some social impact sukuk, but not really something that would be linked to women empowerment, women employment, and the pricing would be based on how much impact factor is incorporated. So I think there's a huge scope for innovation out there, and I think Islamic finance industry thrives on innovation. Its basic premise is innovation. So I think I fully agree with you. I can't agree more. So I am cautious of time that we might be getting some more questions now, but until we assemble all of them, let's go back to Eric on understanding how principles of responsible banking can help the future of banking. Is it the life-saving opportunity for the banking? This is how you look at it?
Well, thanks, Dr. Ali and Catherine. And actually, Catherine, raising Islamic finance, I mean, those working in and aware of Islamic finance approaches, actually, I think we'll see a lot of familiarity in the principles for responsible banking. I think it's a newer framework for those outside in the traditional banking sector. I would say it's more different for them. But if I could frame it a little bit, explain it. Let's go from the start of the SDGs. So we know that there's a global funding need for the SDGs. You know, people talk about something in the order of $5 to $7 trillion US annually. In Arab countries, the financing gap is estimated at about $230 billion US annually. And as I mentioned earlier, we see the SDGs largely as a global compass. The banks who are signatories to the Principles for Responsible Banking essentially see their role in making a positive contribution to people and planet, essentially that society expects, and doing good business in doing that. So the way the PRB operates is it's 6 principles. The most important one is the first one, which is around the notion of alignment. It basically says we will work to align our businesses with the needs of societies and individuals as defined by the Sustainable Development Goals, the Paris Climate Agreement, and other relevant frameworks. And essentially, it's meant to be that's the basis for the principles being a framework for guiding banks in clearly defining their purpose, their strategy to create value for society and shareholders, while remaining, as I mentioned, remaining competitive. It's essentially, how do we seize the opportunities of and thrive in a changing economy and society? The 5 other principles, I won't go into total depth into them, but roughly the second one, which I will describe as very, very important, it talks around impact and target setting. And then the remaining ones are focus on clients and customers, stakeholders, governance and culture, and transparency and accountability. I think the unique elements of the framework is the notion around aligning all lines of business to contribute to individual needs and society goals. And that implies essentially having a forward-looking orientation and essentially, for the first time, trying to come to grips and understand what are the impacts of the financing that we as a banking institution provide. We typically, we measure the risk and return attributes of a specific transaction, but do we really understand what our client is doing with the financing and what type of impacts go along with that? Are we creating jobs? Are we providing access to energy, water, education, services? Are we able as a bank to actually capture what that impact looks like? Also, what are the negative impacts? And this is an area typically banks are stronger, historically, as I mentioned earlier, in tracking what are the potential negative consequences of the activity that we are financing. So that's really the strongest new notion. And as a bank signs the principles, what they essentially are committing to do is, in a first instance, and there's a time frame, a period over which these steps are taken. In the first instance, it's to put in place systems for monitoring impact across all lines of business, and most importantly, being able to identify the most important impact areas. So it's in the specific wording around where it matters most. So as a bank, your own paper consumption and your own energy consumption, those are not the biggest impacts that you have. Now, they can be worthwhile, obviously, to be tracked, but the environmental impact or social impact that you have as a bank is not so much in what you do directly, your own operations. It's very clearly about what your clients do with your financing. So the signatories in a first step have to put in place the systems, and this is a very new area, to try to monitor impacts and identify the most significant impact areas. Second requirement is that once you understand the impacts, to prioritize and then to set specific business targets at any one time, at least 2 of the impact areas, and it's supposed to be the most significant impacts that you have as a bank. So it is about disclosure and about a bank actually having this discussion with customers, with clients, with regulators, with civil societies to say, we believe these are the most important impact areas where we're operating in our own business context, and we're actually going to set some targets to transition this over time. So if I could take, a classic area, energy sector lending. In not all banks, but many banks basically realize that the energy system, which is going to have to transition, that's a very significant impact area, and therefore it's initially about having the tools to monitor the environmental social impact of the energy systems that we are financing, and then it's about saying, okay, what is the forward guidance we want to give in terms of setting a target about what share of financing we're providing today versus where we want to get to in a defined period. How much of our financing today is going to renewable energies, let's say, low carbon, how much is going to very high carbon, how much is going to transition business activities and essentially transition fuels, etc. So it's really about starting to disclose and having that forward guidance conversation with key actors, which is at the core of this notion of alignment. Which is the center of this framework. Last point, there are very important elements around engagement with civil society, and there's a civil society advisory body to foster that engagement, which in many places is a difficult discussion. And through having a body who can provide inputs on what they believe are some of these most critical issues that should be looking at, what are the new issues coming down? Catherine, you refer to the blue economy. Do we understand what the environmental risks are in terms of our relationship with the world's oceans and other and the seas? So the relationship with society is an important one. And around all of this, as I mentioned earlier, it's around being transparent and accountable. So there are reporting requirements. Signatories do not put out specific reports, but they're required to report through their existing reports, whether it's to CDP, GRI, or through their financial or their integrated financial reports. There's certain information that they are expected to provide on a specific schedule, and that reporting needs to be assured. So it's third-party assessed, basically, to give credibility, to prevent the type of greenwashing that Catherine, you referred to. So that's kind of gives the framing of the principles. And as mentioned earlier, Al Baraka and GIB are 2 of the first signatories in Bahrain. Globally, we're almost at 200 signatories. Now, there are many more banks in the world, but those 200 signatories represent just over 40% of global banking assets. So it basically gives you an understanding that most of the banks are the larger actors in their markets. And so this is not niche. I mean, there are all types of banks within the 200, but most of them are not the niche players. Most of them are the big banks. Coming back to, I think, what you referred to, Dr. Ali, at the beginning, this notion of impact, it's no longer a notion of philanthropic. This is something you do at the sides as an add-on. This is actually something about core business. This is about everything we do and understanding what we do, what impact it has, and how we probably need to start adjusting and being ahead of the curve in making sure that we're financing the right sort of industries, and we're working with all of our clients to help them make these transitions that are needed as we work our way forward.
Yeah, thank you. I'll come back to you on the future insights towards the end. And so Catherine, I want to ask you so many other questions, including on biodiversity finance and clean air finance. But at the same time, I want to understand what are you doing as a CEO? What are your strategies? How are you including sustainability into your business?
Thank you, Dr. Ali. Well, I think I've certainly said that you need to have it embedded at the heart of your strategy. It can't be something that you perhaps sort of pull off the shelf once a year. And I think actually coming back to something that we've been discussing, organizations need to define your purpose. If you set your purpose, then I think you know where you're heading. And the purpose of our organization is really this idea of mobilizing and scaling capital in support of sustainable development. And as an asset manager based out of London, you know, we have an extraordinary heritage with a long history of experience and partnerships across the GCC region. But we also have a very clear vision for the future. And the vision for the future is that you have to take these factors into account. So very practically, what are we doing about it? Well, firstly, we made sure that we got our own house in order. So we effectively did a sort of sustainability audit on ourselves, and we've been mapping our journey since this started really only a couple of years ago, about 2.5 years ago. And this has really then evolved into an active sustainability advisory service that we're now actively speaking to clients about in the region to help people who perhaps are facing similar challenges and don't really know what order and what steps do you need to take in order to really have a lasting impact on the world around us. So our whole DNA is about providing solutions for our clients to have a more sustainable future. And sustainable actually has two connotations here. One, it's so that it will be less harmful from their perspective in terms of investments towards the planet, but it will be more sustainable because the returns will be far less volatile. You are actually going to be backing the right kind of organizations, the right businesses. Back to Eric's point, not all companies in every sector are good or bad. You have to differentiate. So one of the key things that we've been working very hard on with the team in London is effectively we've created a proprietary database where we're analyzing millions and millions of data points to effectively pull together our own screening methodology. So for each company that we're investing in, we're probably analyzing over 2,500 data points at the raw data point level. And what we really want to be able to do is to have the data and the transparency and put those together, as I said, in both active equity and fixed income solutions, as well as passive solutions. So if people want exposure to some of the SDG factors, we can effectively create an SDG aligned portfolio for you. And it can be full replication, it can be partial, but you're effectively, therefore, very much able to create a bespoke portfolio. But I think the other point is that, you know, we want to be part of the solution. And if you go back to what the SDGs were all about, SDG 17 is partnerships. And actually, this is why we're all here today, because we all passionately care about creating a better world and using the wherewithal from our own backgrounds, mine being banking and asset management, to do something useful during our time on this earth. And so we look back and leave our organizations in a stronger place with a more engaged workforce, with happier clients, and with a more sustainable planet. I think if we achieve that, Ali, we will have done great things.
Wow, beautifully said. And I think that really provides the philosophical and aspirational topic for the action that you and other leaders in the banking industry are championing. Thank you for that. And so the last 30 seconds, maybe, Catherine, starting with you, where do you see the future? And then we can go to Eric for his 30 seconds.
My 30 seconds would be the finance sector is an important agent for change. And I think everybody needs to decide whether you want to be part of that change or left on the sidelines. I think the choice is very stark, and the call to action is join us, create the change that can build a better world. Thank you.
Thank you. Eric?
I think building on Catherine's comments, I would say that understanding the risks as these changes occur across all your clients and sectors is very important. And I think it's not only about seeking opportunities. I think it's about understanding your entire the alignment of your portfolio and understanding how the sectors that you operate in are going to be changing as we transition to address these sustainable development issues. And it's no longer about sustainability being a sidecar. It's about how do we change business strategy? How do we turn the ship? And it's only through that orientation are we able to set strategy the way you can navigate, I think, a really successful way forward.
Thank you. Thank you so much, Eric. And ladies and gentlemen, we have come to an end. We promise you that we'll do a sharp stop by the end of the hour. We are there. And I have learned a lot from these two amazing leaders, and I'm sure you have had the same experience. So on your behalf and on our behalf, I would like to thank once again to Eric and Catherine for all what you have shared with us and for all what you are doing every day. And you are truly an inspiration for all of us who are the advocates of sustainable finance. Thank you. Thank you so much.
Thank you very much. A pleasure.
Thank you.
Have a nice day, everyone. Bye.